Hi, Pat Moran from Healthier Money. So, going to talk today a little bit about a strategy that we've used successfully to manage money for years now, and our clients really seem to enjoy it, as well as most of the people that we talk to about this strategy. Arizona today, our friend of the show, Governor Ducey, today announced that we are now reaching a stay-at-home point here in Arizona. We've had a real explosive outbreak of COVID-19 on the Navajo reservation. We're up over, I think, 200 or 300 cases so far. So our stay at home is going to be 30 days. All the school has been canceled for the rest of the year. So a lot happened in AZ today. On a personal note, my right hip's been killing me, so might be moving around a little bit gingerly today. So I'm just giving you that disclaimer. And also want to talk to you a lot about kind of what's been happening, again, this strategy. So we all know the market's been extremely volatile. We were up, I think, 900 points today, mostly because you had some really favorable news from some of the healthcare companies. Abbott Labs came out with a test that can literally tell you if you have the virus in 5 minutes or so. Johnson & Johnson's working on a vaccine that essentially they think could be out at the later part of this year, maybe September or so. You've got other companies that are out there, Gilead, Regeneron, Moderna, all these different companies that are throwing lots of resources at cures. Eli Lilly's going a big way with antivirals and trying to figure out, cures from a genetic level. So really good news today on getting out in front of this. So the stock market viewed all that and went up some 900 points, kind of recovered the losses from Friday. And we've really had a good clip here of 5 or 6 days where the market's off of its 35% low. I still think we're going to finish up with the worst month in the market since 2008. At one point, we were sitting with the worst market going back to the Great Depression, but we've recovered a little bit, so we'll see what happens tomorrow. What has recently come out, which is not favorable, is unemployment claims jumped over 42 million this past week. Again, the third week in a row, we've had record amount of unemployment claims. So we've also seen negative forecasts as far as GDP goes, companies restating earnings. I have seen a couple of things that Goldman Sachs, a few companies are out there thinking the S&P will rally by the end of the year, maybe around 3,000, but everybody's calling for a very soft, unpredictable, extremely volatile stock market. And so when we're in these, type of periods, one of the things that we're worried about is, the bull market was a long bull market. We had a heck of a run. The Dow was up 253% from the lows of March of 2009. And I know I was on the table for months saying, please, no one ever went broke taking a profit. Get some money off the table. Because what's happening now and what's happened recently is we're getting a market that sneakingly is looking like what happened in 2008 with the financial crisis. Now, I know that companies are a lot better off today than they were back then, and the solvency and some of those issues. But again, you're going to have companies that come through this that are no more. They literally will go out of business. And my fear is this economy is driven, 85% of it is the small mom and pop, the small businesses that run this country. And, I walked through the mall on Saturday. If we have our office in Scottsdale Fashion Square in the mall next to the Apple store. This mall is easily the busiest, if not the single busiest mall in Phoenix and Scottsdale. Very nice mall. A lot of great stores here, and it's usually packed. And on Saturday at 2 o'clock in the afternoon, I was working here over the weekend, there was not a single soul in the entire mall. And I walked down the mall just to kind of, see what was going on. There were 2 places that were open in the food court for takeout. Other than that, every single store was closed. And I started thinking to myself, these are all people with jobs that need this money to pay their bills, their cars, their mortgages, are sitting there, not being able to work anymore. And we're starting to see with the unemployment claims, and frankly, boys and girls, we haven't seen anything with the amount of unemployment claims that are going to come down. You're already getting cries saying, the stimulus package just got passed, and we need another one right behind that. So we are going to get a lot more volatile, and a lot more crazy things are going to happen in the short term. In particular, one of the things that I'm concerned about is where this market ends up going again. If it's like a market that we had in 2008 and 2000, when we had a market that went from 2000 to 2009, that was a period where we had a negative market during that time. I used to be able to tell people in every 10-year period the stock market went up. Didn't go up in that period. So now I can say in every 15-year period. But what happened is we had a really violent correction in 2008. And everybody remembers that. Market's down over 37%. It was crazy. It happened so fast. And the market really was in this tailspin and this lull from 2007 March to 2009. And while most people remember that, they don't or forgot about what happened in 2000 and 2002. We had the tech bubble. Everything that was tech-oriented basically blew up. And so when we had that, it just happened slower. It wasn't as violent, but the market actually went down more. So we had never had a decade with two black swan events like that where the market was down in excess of 30%. So imagine that you go down, you're just coming back up, and you go down again. And it takes time to come back. So that we spent 9 years of cumulative returns that were roughly negative 1%. Now imagine that you're a fixed income investor, or you're just retiring, or I could throw out any number of scenarios and that happened to you. I've told lots of stories about people that came into my office and unfortunately that happened to them. And we could be in a period here where, bear markets on average I think last 17 or 20 months. We could be in a very soft period here to where this market is very sluggish. I've talked about maybe taking some of these little pockets of strength, selling into them, maybe take money off the table and reposition to de-risk the portfolio, maybe be a little bit more predictable or get better income if that's your deal. Stocks right now are paying good income and good dividend flows, which are certainly better than your treasuries and your CDs. Again, I wonder about that. Companies, the first thing you can do to raise cash if you're a company is cut your dividend. Reduce your dividend. We've already started to see that happen. But those dividends, not paying them out, are cash that can come back in the company that can be so powerful and so vital to their longevity. So, it's great to pick up income stocks. I know I've been buying some in here and building some positions, things, like Verizon or AT&T, Qualcomm, J&J, Procter & Gamble, Nike. I could go on and on. But some of those companies that are out there paying nice dividends and we become enamored with those dividends financially may not be able to continue to pay those dividends moving forward. So you need to really assess the viability of those companies. I talked to a friend of mine today who has a lot of options as part of his package with his employer. And I talked to him, I said, how's it going? Because their stock's really gotten hit hard. And he says, the good news, Pat, is we have a lot of cash to weather the storm for the next couple of years. But as far as dividends or doing anything like that and bonuses and stuff, we've shelved all that. So, we are seeing our customers are really questioning, some of the expenses and doing some of the upgrades that we were out there trying to get them to do because they're nervous. And they want to sit with their cash close to the vest, and they're not sure what's going to happen. And even some of them, he said, have started laying off some employees. And he goes, fortunately, we may have to move some things around or furlough some people in the short term, but we should be okay. So when you're looking at companies with good dividend streams, you want to look at those track records of consistency. You want to look at strong balance sheets, and you want to make sure that those dividends are going to last. Is Verizon's dividend going to last? Frankly, I feel better about Verizon's dividend than I do AT&T, but I think both of those are going to be huge players in this whole 5G movement and what happens going forward. So, I think both of those stocks could attract a lot of interest, and both of them are, decent yields at this point. And you've heard me, time and time again, I've talked about Abbott Labs, and we saw a good move in that stock today, but great income player in the healthcare. Healthcare stocks are doing great. And the healthcare stocks are places where people are going to look for consistency, blue chip stability. You also are seeing that in some of your staples. I joke and say I think Amazon and Walmart are going to rule the world after you come through with this because of the at-home economy and the fact that people can order their packages. Maybe you leave it out there for 2 days to disinfect, or in the sun here in Phoenix to hopefully burn off any of the virus. But the reality is their sales are booming, and they're adding tons and tons of people. I did read recently where there's some strike concerns that people don't feel that given the increase in business, first of all, that they're being paid accordingly to be able to participate in the crazy business growth that the companies are having. They want some more money, but a lot of more of them are concerned about personal safety type items and making sure that the workplace is doing everything they can to make reduce the virus and the chances of getting the virus, and with masks and shields and the different clothing and things. That's been in high demand everywhere, and you've seen on most of the news shows and cable shows doctors and nurses and governors and people complaining that we just don't have enough. And now corporate America, many companies are coming to the rescue, retooling their factories, coming out with things that they can help. I think I saw where Jack Daniels is making hand sanitizer. You've got Johnson & Johnson making masks. We're trying to do the best we can, but you're not going to see the effects of this virus end tomorrow. And I don't know when you're going to see it. Some of the people that are in the know said it's going to be a while. It's going to be, maybe at the end of the year we get a vaccine. Maybe it starts coming back around again at the end of the year and we have another, set of infections. I don't know, but this is going to be an overhang on the stock market. So you need to be positioning your portfolio to make sure that it can weather that storm, but also potentially weather more storms that are going to come. They're going to come. It's the nature of the beast. History repeats itself. Bear markets happen. Corrections happen. And depending on where you want to be with your plans and how you're doing it, I don't care if it's long term, okay? Having 100% in stocks and the bonds and things could be a very risky story, and you need to be careful. And you need to diversify. So what we really stress here at Healthier Money, as I've said, we look for a strong base. And I bring out this chart because in this chart what you'll notice is protections first. Everything from proper insurance, if gosh forbid something happened to you, all the liabilities and potential costs that are associated with that, car and health and liability and homeowners and different things like that. Life insurance, gosh forbid you got a family or there's needs that people are counting on and something happens to you. And I use a lot of life insurance that has access to the death benefit while you're alive to help out with things like critical illness or chronic illness, Alzheimer's, cancer, stroke, heart attack, things like that. Being able to create a stream of income off that death benefit to be able to pay for those things is an example of protection. But also there's some really cool things you can do in that bottom part of protection to protect your money, get some growth, and in some of these situations, get that growth or that income completely tax-free. So we have that protection. The next thing is liquidity. Too often I see people that their liquidity and their cash is in the stock market. And they say, hey, the market's been going up, I'll just sell some of my stocks and I'll get $10,000 to go do that home repair or whatever it is. That is not what we're talking about. Liquidity is actually money that you've put aside to be liquid, to be able to call on a rainy day and not have to go and get your $10,000 when we've had a 20, 30, 40% correction in the stock market and you need 10, but 4,000 it was lost from a market correction, so now you have 6. So when the investments that we're doing, and the other strategy that I'll talk about is liquidity. And we always feel that with our retirees, liquidity and flexibility is super important. And we'll do some of this with the pre-retirees too. And that is one of the functions of repositioning the portfolio because we'll really get in there. I talked a little bit about gold matching and some of the things that we do with our clients, but really going in there and having a candid conversation and laying out the portfolio the way it needs to be laid out to be able to take care of those needs, maybe a short-term, medium-term, long-term type buckets, figuring out the strategy and making sure there's enough liquidity along the way to do the things that they want to do, get the income that they need, live their retirement dreams, or be ready to retire and being able to do things that they want to have as far as extra cash to maybe travel or see the grandkids, maybe to pay down the house. Whatever that is, liquidity and flexibility are important. Then we get into stability. Now, stability and things like that could be, stocks at this point. For myself, some of the stability has been big blue chip, strong companies that I've owned for 30, 40, 50 years. Let's take 50 years back. We're going to say 40. That I've owned for long periods of time that are stable. I might give up some of the pow or the growth on the upside to have that stability, that predictability, that maybe 5 to 7%. that's growing a year. Some of these people out there that are just pounding the table and say, oh, throw it in a great mutual fund, you'll make 12%. Load of crap. All right? They're not making 12% mutual funds that you can just go throw all your money in and hope that it's going to work out. I also feel that this buy and pray mentality that a lot of brokers used to use, and I'm guilty of that. I was one of those people of saying, hold on to your stocks. Everything will be great. You'll be fine. This correction's going to come back. It's okay. It's a momentary blip, whatever that is. That's ridiculous. Okay? That's going to happen with that piece of the portfolio that's in the stability type bucket or this growth bucket. All right? That's not the piece of the portfolio that's down here with liquidity or protection, things like that. I mean, I talk to people about their retirement monies. Okay? Talked to a couple today. They're in their 50s. All right? Most of the money that they have right now is in the stock market, all but about 90% of it. And they've been very successful. Okay? But I told them, I said, what if? What if the company slows? What if you get massive corrections in your retirement accounts? Just what if the job doesn't work out and you want to change? And he told me, funny that you would say that because all three are happening right now. And I need to de-risk the portfolio. I want growth, but at not all the costs that potentially come with it by just simply buying things in the buy and pray method. Talk to another person that's using the 4%, the old classic withdrawal scenario on the portfolio, where they stay invested in stocks, they siphon off 4% a year, and that's how they live. Because that theory's been around there for years. And the guy that invented that theory, they've talked to that guy today, and he says that was not supposed to be the catch-all, the proxy that everybody used to manage their portfolio in the stock market with income. As a matter of fact, if I revisited that today, I would be more in the 2% change rate. I wouldn't be at 4%. The adage is if you can make 4% of the portfolio, you pull that out in the way of income, and then if you get 5, 6, 10%, whatever that is, that portion can go back into the portfolio to grow. Next year you get your 4% income, your portfolio is growing. Not happening in 2000 from 2009, or not happening since what's been going on with our markets in the beginning of the year. And we don't know where this is going. I've said I think it's going lower. It has to price in a number of things that have been happening. When I walk down the mall and I see in essence over 100 plus stores closed, that says something. Those are people with real jobs that need that money, that aren't able to do the things that they need to do to survive, let alone have money to spend in this economy. The economy is driven by sales. People going out and spending money. That's what companies drop to the bottom line in the form of profits and earnings. That's what drives stock prices. And that's not happening. Especially when you go down our mall and you see all these people are driving into Phoenix. I had to take my family this morning to the airport to, unfortunately, go back to the Midwest to bury my mother-in-law. And they're going to do it this weekend. I went to the airport, there was 3 cars. 3 cars. It's Sky Harbor Airport in Phoenix, Arizona, which is one of the busiest airports probably in the country, maybe the world. And there was 3 cars. All right? It's crazy. It's, I said it's like the Living Dead or the Walking Dead is real. They knew what what was coming. They just did it 6 or 7 years earlier. I mean, it's crazy. Who would have thought about all this stuff? So you need to be prepared. And then that last part is this growth segment. And that's probably the part that you have, your growth stocks, your apples, your things like that. I'm not a stockbroker, so you can go talk to your advisors to get their opinions and things like that, or maybe you buy some index funds that are focused totally on growth. That's okay, but you can see, or your 401ks and buying company stock, things like this, you can see it's not this part of the pie. It's not this. Okay? It's this. It's that piece of the pie that as you move up is more risky, but also you potentially might have more in the way of returns. Ironically, you don't necessarily need a lot here to really move this number over the long term. And I'm not telling you to not have money in stocks, because you should, and bonds and things. Where it's appropriate, matches up with your goals, the advisor that you're working with, he or she is going to give you good information. It's just not what I do with our clients, and just not what's for me. I build the base personally, build the base. 75% is in predictable, steady things that I know that are going to be there that ultimately are serving an objective, and 25% is in my growth stocks, and I add to them. I added to them last week. I told everybody, add a couple $100,000 here, nibble, pick some things up that were on sale. All right, and you keep nibbling. So we did a buy with some people. I let them know this is what I was doing. So I think cumulative, there was a couple $100,000 that went in with different people. So again, it's nibbling a little bit, okay, but making sure that you have the lion's share of your money in those predictable investments that have flexibility and liquidity, maybe some tax benefits, but aren't going to fall apart at the first sign of market trouble, which is what's happening right now. And I'm seeing it every day, and I'm talking to people every day that said, why is this reminding me of 2008 again? And I tell them, I said, I'm sorry. It's, this is a crazy market. So as we move through, I think our little piece of technology here went by the wayside. As I talk about that, what I'm trying to tell you is be able to manage the portfolio constructively. We try to create a balance between financial failure and financial success. We want to err on this side, not that side. And we know by taking our approach, we're going to end up here and not here. To each his own. All right, so as we move through there, what's next? Well, I'm sure Mr. Trump is worried about this election that we're going to have in November. It seems like everything on the election front is just stopped. You don't hear about Biden or Sanders anymore or Trump. I mean, the country's in a huge battle right now. It's fighting a silent enemy, the coronavirus, and all the resources, all the talk, everything that I watch on news and modern shows and social media and stuff like that. It's a full-on fight. Whether you're in New York or LA, now you got Detroit acting up, and you've got Chicago, you got problems in Louisiana. All right, we do not know the scope of this and where this is going to go. Okay, I saw today that 200,000 deaths, maybe 300. Okay, the president's close advisor and Fauci were saying that we could be looking at 200,000 to 300,000 people pass away. It's crazy. All right, and frankly, I think we should have done a better job of being out in front of this. We dropped the ball. All right, but we have this election coming up, and maybe if Trump doesn't get elected, maybe the stock market doesn't like that. I don't know, but it seems like the election right now is in the back of everybody's mind. I don't even know if we're going to be able to go to the polls in November, but we do have an election coming. We just had a huge stimulus package of a couple $1 trillion, and a lot of people are saying we need a lot more. We need another one right behind this. We need one for small business right behind this. So we could be looking at records amounts of these stimulus packages. You have the Federal Reserve and the IMF are wide open, full throttle, and putting liquidity into this market. I think the Fed went over $5 trillion of stimulus and buying and everything from mortgage securities to stocks to bonds. I mean, they're adding liquidity like there's nobody business. Now the IMF, International Monetary Fund, says that they have $1 trillion that they're ready to deploy because they're seeing the world and global economy slow down. All right? There's that word recession out there, pandemic out there. Those are not positives for the stock market. And some of these rallies today were simply because some of the healthcare companies said, hey, we have a better test, so we can do it quickly. Hey, we may have a cure in the works 9 months from now. All right, there was some signs of hope out there, but not tomorrow. So the market was looking for good news after being down 25, 30%. So it was only natural we might have a little bit of a rally. I don't think the underlying fundamentals are going to sustain this. And we could touch lows again. We could be down in the 18,000 and change range on the Dow, which is where I thought we were going to end up. S&P was going to, be down in the 2,000. So we could have a market that sits on pins and needles in election time, have some problems there. This huge stimulus package, maybe have some problems there. You've got all this cash coming in, okay? One of the things you got to start asking yourself is, where's this coming from, and do we ultimately pay a price for this? Yeah, we do. All right? Our tax revenues right now aren't even covering the debt going into this. We're not even paying the interest on the government debt that's over $23 trillion going into this. You can go to the national debt clock, okay, it's .com or .org, and you can see the debt, what's going on with it. And you can see where we are in revenues. I think we are, need a 106% increase in taxes just to cover the interest. And now you got all these other supplement packages coming in. You got companies out there trying to say, if you buy a car, we'll give you the first 90 days free. Banks out there and legislation out there saying, if you can't make your house payment for 30, 60, 90 days, don't worry, we got you covered. You can't make your car payment, don't worry, we got you covered. Can't make your student loan payment or your interest payments, don't worry, we have you covered. People, it's got to come from somewhere. All right? Chances are, taxes. You can't keep writing these enormous blank checks and not think there's going to be some repercussion for that and not think at some point that's going to get priced into the market in a negative way. I've been doing this for 34 years. To me, the biggest crash I've ever been through was '87. It was the worst one. Market was down 22%, 508 points. People were sitting at their computer saying, my life is over, my job's over. I'm done. Right? I've been through that. I've been through 2008. I've been through the flash crash. I've been through all of them. Okay? They become a lot easier to stomach and a little less worrisome when you've properly planned your portfolio and you have some assets in there that aren't going to go down at the first sign of trouble. And that's not 100% in the stock market, and that's not this, the buy and pray. It's just not. So we have that going. You have a quarter of the U.S. population right now is being asked to stay home. Stay home. Stay in place. We were in Hawaii a week ago. We left early because the governor of the Hawaii said, hey, I know we thrive on tourism, but we're asking nobody to come here. We're shutting down. Pull everybody together, get the red eye, and come back. Happened here today in Arizona. Just a couple hours ago. School's over for the year, and let's go stay at home for 30 days. That's companies not getting money. That's money not going back into the economy. I guess it's money going to Amazon or Walmart online or Instacart or some of these other places, but the reality is that's a very small portion. And the way we spend money and how we do it and what we do going forward, it's changed forever. We're not going to have a lot of this anymore or a lot of this. It's going to be a toe tap, an elbow tap maybe if you're really venturous. Things are changing. My daughter and all of her friends just got together and they did a car chat where they all went in their cars and they went to a parking lot and they all backed up next to each other and they chatted while they sat in their cars. Car chat. I saw today where picking up the phone and making a phone call is up over 35%. Verizon released a stat. We are busier and our networks are busier now than they've ever been. Why? Because people are picking up the phone. They're not doing this. Okay? They're not. What
Go ahead.
Okay. Sorry about that. I was reading something. Somebody was texting me as I come in. So I will go ahead and answer that question towards the end of my presentation. All right, just to be fair. All right. So the volatility in this market is crazy. I think in just over the last couple of months, you've had 8 of the 10 largest drops in the stock market, and I think you've had 5 of the 10 largest gains in the stock market. All right? And that volatility is crazy. If you played the VIX, which is this volatility index, it was up over 350%. And you could have just made a fortune. My brother was trading a little bit. He said it's crazy the amount of numbers that are going on and the amount of money that can be made. All right, why? Because there's so much unpredictability and so much volatility. And if you're sitting there owning a lot of this, you're probably pretty nervous. And the numbers and what's happening is only verifying that this volatility and the downside risks that are associated with the market are very real. Because you know what? The down events have trumped the up events. There's a lot more down events, and sitting at historical records on down events over the last, couple of weeks and couple of months, as opposed to how, we did have the biggest gain ever, like a 2,000 point gain. I think it was like last week. All right. And we had a good week last week, and we ended Friday on a down note where we gave some of that back. But that just happened last week. All right. In history of the market, you've had some of the worst drops ever. You had down 13% almost. And that happened like on March 16th, March 12th, you were down another 10. March 9th, you were down another 7.9. March 11th, down 5.8. I mean, it's crazy, these drops. And so what we like to do is do a portion of our portfolio that when we're down here, we don't participate in the drops. We're out. Zero is our hero. When the market's dropping 5, 10, 15%, guess what you're getting? Zero. You're not, going down 25%, waiting to go back up 33% to get even. You're at zero. Not losing a dime. Then we talk about things like, we talk about with that volatility. Do you have that next one that I have? That slides? What we talk about and what I'm really concerned about is what's the next bubble to burst? All right? We had the tech crash. We had things like the S&L crash. Oil. Oil was below $20 today. Oil. I think ExxonMobil was like the largest company ever with capitalization like 8 to 10 years ago. Now it's getting crushed because oil prices are so low. And Russia and Saudi Arabia are out there fighting it out. Got uncertainty there. We've got things like COVID-19. We just saw it. What's next? What's next? You don't control any of those. You play the victim. You don't play the person that's controlling your own destiny in those situations. That's why I think it's so important in your portfolio to have some things that will insulate you from those crazy down events that you haven't been able to, to take care of on your own. There's so many people that not having control on their money in this market drives them nuts. And COVID-19 is just the latest thing to happen, and who knows what else is going to happen. Right? Do you want to be 100% in stocks, unprotected, unprotectable, and unpredictable, and see where all this goes? Probably not. Right? Another strategy that we have is what we do is we follow a time-tested investment philosophy. Now, for years and years and years, I've been in this business. I've told the story where I got hit by a car when I was 15, lost the right side of my face, my teeth, my tongue. I got third-degree burns, fake kneecap. I had a lot of stuff happen. And so I got a trust from that event very early on in life. And I was kind of, in a position with my dad and my broker to really have to manage that money and a number of things that went along with that. So through that, I became really passionate studying investing. I was a broker, a financial planner, a branch manager, top producer for 2 companies for almost 10 years. I mean, I've worn a lot of hats. I've had so many designations after my name. It was crazy. All right. People would spend all this time, hey, what are all these letters after your name? People just want somebody to talk to, somebody they can trust, somebody that's got some experience. I got a few gray hairs. All right. And they want to know, hey, what should I do? So I went out there and I started studying some of the investment philosophies that are out there that are successful. And one of the things that really was interesting to me was this whole concept of the endowments. And that was your Harvards and your Yales and your Stanfords and those companies that had amassed huge sums of money in their endowment funds. And I was sitting there going, are they losing 35% in the stock market? Because if they are, how are they building all these new buildings? How are they, adding to the football stadiums? How are they creating all these campuses? Arizona State University has a main campus, out west, has a huge campus downtown, and has another campus that they're building on that side of town, all connected by a tram. Okay? Unbelievable amount of resources. U of A moved their whole medical school down here. Creighton moved their medical school down here. We have a big hospital called St. Joseph's Hospital, which we're not spending a lot of time there. And it's become a huge teaching hospital. Okay? The amount of resources, the dorms, the apartments they're converting, the huge grocery store they got built down there, all of that stuff is getting built with their cash flow, with their resources. Do you think that can happen if the market's down 35%? I told the story this past summer where I took my little guy out east to a Red Sox game. Something ingrained in me since I was the little guy. My dad's from Massachusetts and he loves the Red Sox, loves the Bruins. And so I said, Charlie, happy birthday yesterday, by the way, Charlie, happy 16. I said, let's go to Boston. And he wanted to go to Maine and see Maine and have some lobster and stuff. I said, let's just go. So I grabbed my wife. For those that know you or those who know me a long period of time, I have a tendency to be spontaneous for a lot of reasons. But the reality is we went. And we were out there and on our way, when we got there before the game, I said, let's go by Harvard. And Charlie was like, Dad, I don't think I'm going to Harvard, this and that. And I said, Charlie, I didn't go to Harvard. All right? I just want to see it. So when we got on Harvard's campus, they had 7 of the largest cranes in Boston working there. And I was talking to a guy, and a guy said, the most cranes right now are here on this campus. And they were building 2 new dorms. They were adding some classroom facilities, a new fine arts stadium, building. It was crazy what was going on. The campus was having major construction. And it's Harvard. So you knew they were spending tons of money. It's like with these colleges now, it's become this huge competition. Everybody's spending more money, make it like a spa-like great experience, recruiting students. We're paying a lot of money. As I said, this class, this 2020 class is the most indebted college class ever. And they're paying all this money because these campuses are beautiful and lifestyle and things like that. That's changed forever, by the way. But they're spending money. They can't do that if they're losing 30, 40, 20% in the stock market for 2 reasons. They don't have the cash flow to continue to add to that infrastructure and do the things that they want to do to improve their services and their buildings and really help the student with a first-class experience. And number 2 is, what donors are going to want to donate to Harvard if they're losing 25, 30, 40% a year on their endowment fund? I wouldn't. I wouldn't be going out there crazy to make gifts knowing that they're losing all this money. So I started studying the endowment funds, and they did something that was pretty interesting. And what they did is they took their portfolio, and most of the money in the portfolio, they had in things down here. Protection, liquidity, safe, okay? And that was things like, things like, annuities, things like real estate, things like commodities, private equity, different things like venture capital, all right? And some of these things I'm talking about, everybody's like, oh, that's too much money, I can't qualify, and I can't do that. No. There are hedge funds out there that are giving you access for as little as like $10,000. There's a lot of great investment choices or ETFs or different indexes that mimic some of this stuff, and you can get started for very little. So this stuff is available. But the lion's share of their money is in things like this: life insurance, assets that are non-correlated to the stock market that have some protection levers in place. And when I really studied the portfolios, guess what? They only had about, it looked like 5% of their money was truly in individual stocks and individual issues. They didn't have a bunch of money in the market. They certainly weren't doing this. All right? What they did is they built a portfolio that helped do the things that they wanted to do. Preservation of capital was huge. Consistency of income was huge. And not taking big hits in the stock market was huge. That's how they were managing money. And I turned around and I said, why can't I do that for my clients? All right? I'm not going to provide a lot of value here. Frankly, there's all these resources and things out there right now where you can go to Vanguard or Fidelity, buy a couple of great index funds that mimic this growth model, and go do it. You don't even need a professional guy charging you 1% a year to even do that. I've had so many people come in and say, oh, I made 20, 22, 25, 18, whatever percent. Great. I'm so happy with my person. Great. You know they underperformed the basic index of the S&P 500 and you paid a point on top of that? Okay? Meaning you could have just bought some index funds which are less cost, not paid those expenses to manage your money, and probably done fine. And I'm not bagging the brokers out there because there's a lot of brokers that do a great job. Okay? There's a lot of brokers that are worth their grain of salt. All right? With other, things. When I talk about money, it's just one piece of a much larger pie that I talk about. I address everything. All right? But I'm not going to provide a lot of value here. Too many resources, too many things that people can do on their own. I can help, maybe offer my opinion or my 2 cents worth. But I can do a lot here because people don't know how to do this, or maybe they haven't heard, or they're confused, or maybe they read something negatively, whatever. There's a lot of crap out there, frankly, that keeps people from looking straight ahead. And a lot of noise that says, put your money in stocks, you can make 12%. Okay, well, I know who that person is, and that just doesn't happen easily. And how would you be feeling about that right now with your portfolio being down 20, 25%? Because most people don't have the intestinal fortitude to be adding here. They're frozen. And I know I've talked to so many people that are just frozen. They don't know what to do. So we do this. That's the value that I provide. And endowment funds do it really, really well. And there's this debate between growth and protection. I'm going to use that debate of stocks. And everybody says, well, Pat, if I'm not in the market, how am I creating this inflation hedge? How am I growing my money? How am I going to make my money last? I'm not talking about jettisoning out of the stock market. I'm not. But I'm talking about growth with protection, which is exactly what the concept of indexing does for you. And when I look at those, large endowment funds and things like that, that's what they do. And if I take a look at a time here, all right, and I take a look at what's going on with the stock market, I look at like the last decade, really, just what did the S&P do just on a growth potential, all right? So here's the market doing this, okay? It averaged a little over 6%, just from an appreciation standpoint. All right, so we've got this block of time from 2000 to 2000, the end of last year, about 6%. All right, but I drew this picture, and you notice you've got all these things along the way. Sometimes in the appointment, I call it the heart monitor. Your ups and downs and things of this nature. All right, so imagine now that we could do this. All right, but along the way, we could eliminate that. We could eliminate that. And we can eliminate that. So that's not what your portfolio is looking like. Now your portfolio looks like this. Okay, essentially, you have 0 when things are falling apart, and you have appreciation when things are going up. Right? And there's all kinds of ways to manage this appreciation and potentially grow your money. There's so many different investment options out there. Morningstar, Prudential, Vanguard, T. Rowe Price, Fidelity. There's all kinds of different companies that have these options and have different accounts for you to choose from. We like, an example is Morningstar's Wide Moat fund that looks at, stocks in the S&P that are way down and does diversifying between, different stocks and bonds and cash and real estate and stuff. But your portfolio doesn't like this. What we call these moments where you're flat, 0 is your hero. Okay? And you'll notice I draw it so that every year it resets. It resets so you can't go backwards. So in the indexing concept, if it does this to this, this is your next basis. You're locked in. All right? If it does this, you're locked in. you will never, ever, ever have this. So let's kind of draw a line through that. Give you some of the upside, but none of the downside. So when I take that 6.06% from the 10th, from 2000 to 2019, and I overlay an index concept on this, okay, we're averaging more like 7%. And frankly, we could even have done better than that, and I'll talk about that. Because one of the things that I talk about is looking at a comparison. When you go through and you look at what happened in 2008, what happened in 2000 to 2002, and in that decade, you essentially had a decade where the total return was about negative 1%. You had a 9 to 10 year period where potentially you didn't make any money. And now most of the stuff that's out there said you didn't even come back. If you started in 2000, you didn't get back to even until 2012. So imagine 10 to 12 years of zero returns, negative returns, you're not doing anything. Could you, if you were retired, afford that to happen in your portfolio? Probably not. So that ultimately, here you are with a decade. Well, that indexing concept that I told you about, that did this, in the last decade, when most returns were a negative return or minus 1%, guess what this did? Average close to 5% a year. So in the worst decade that most of us have ever been through, you mean to tell me my money would have compounded over 50% during that time using this strategy? Yep. That's exactly what I'm saying. That's exactly what I'm saying. And we have a great brochure and different things that you can ask for, www.healthiermoney.com. Go to our website, fill out the link right there with the client information, and simply request index. Okay, we have different concepts on there. Just request it. We'll send it out to you. Don't listen to me. Read what's out there. Look at what's available to you in the way of research, because it's pretty powerful. All right? Is this 100% of your money? No. It's my dog. I brought my dog to work today. I think she just freaked out by the eraser. So essentially, it's not 100% of your money. Again, it's that piece. It's that piece of the portfolio that you want more protected, more liquid, more safe type money. It's growth with a protection wrapper wrapped around it. It's putting your leg in the market, maybe not your whole body. It's a good place to be able to have growth. It's a good place to be able to have security of income and not worrying about your principal falling apart. A 20, 25, 30% hit. Right? Indexing is a great tool that we can use in your portfolio to minimize risk and still give you decent long-term returns. Now, as I do that, everybody say, what's the catch? The catch is there's a lot of different ways that you can index. There's a lot of different strategies that you can use to index, right? And each product and solution is different, right? There's indexes out there that give you 100% of the market, or different indexes, or even more than 100%. There's 1 year, there's 2 year, there's 3 year, there's 5 year type of planning of indexing. And we bring all of this together and design the portfolio around what the client needs. But I will never get a phone call when I'm doing indexing with my clients' portfolios. I will never get a phone call, why is my portfolio down 15, 20, 25, 30%? Because indexing eliminates that. And that's where you should start building things of a base to be able to have safe, predictable growth on your portfolio, reasonable rates of return, and be able to grow your money. Because you see what the endowment funds do is they do a great job on protecting your principal, giving me reasonable rates of return, and providing me that consistent, predictable cash flow. The 3 Ps. Okay, and so the way I want to end this up is on that annuity situation. I gave an example in here, And we'll show you exactly, we'll put some numbers to our indexing, and there's a concept in there that we'll share with you on this slide. And what we showed was $200,000 going into an index strategy that essentially gave you 12.5% participation. Oh, excuse me. Let's do it even better. Let's say you just got 50% of the S&P. Let's say you went into a product and that's what the index provided you, is a 50% participation in the market. All right? And we did it for those 20 years that I talked to you about. All right? That money, even with that, grew to $553,000 over 20 years at just 50%. Because you never, ever, ever had to take time to make back all these losses. Because you were staying out of harm's way. And you weren't having, when you went down 25%, to go to 33% to get back to even. That's the beauty of indexing. That's a piece of your portfolio. And there's a lot of stats out there right now that if you did a 60, most people that have a 60-40 blend between stocks and bonds, if you did a 60 stock, 20% bonds, and 20% indexing, you would have improved your returns by as much as 2% a year, and you would have done it with as much as 50% less volatility. So you're telling me by just adding 20% of my portfolio into an index concept, I have the chance to improve my returns and reduce the amount of risk that I'm taking? It's exactly what I'm telling you. So, healthiermoney.com. You can go there. There's a client form on there. We have a couple things going right now. You can write, in the comments page if you want.
In the comments, there's a link.
Okay. In the comments, there's a link. Click that. All right. And we can send you information. We make available a time to talk with you. You can go right in there and schedule something, or simply put, talk to me. It's free of charge. We don't charge, fees for our money management or our investment advice. Right? And we're here to help you. I am trying to do my part, ladies and gentlemen. I really am. I'm trying to give back. Okay? And whether we do business with you or not is irrelevant. It's trying to be a voice of reason in a time that's really crazy out there. And after 34 years, maybe it's helping you with an idea or two that can make a huge difference for you or your family moving forward. Okay? That's what I'm offering. Right? No one has a monopoly on good ideas, but I also know that in times of uncertainty, being able to talk to somebody isn't a bad thing either. So thanks for listening today. Pat Moran with Healthier Money, and more importantly, stay safe and stay healthy. Thank you. Thank you.